Hi, Paul Gerard again, back to talk about an issue which doesn't affect many taxpayers, but we thought we'd include the video anyhow to assist those that does. It's about Division 293, Div 293, taxation. Wow, okay, so if you're receiving a notice, we've probably referred you to this video, but let me explain Division 293. A couple of years back, the government decided that the superannuation concessions which tax super at only 15 cents in the dollar were too generous to some taxpayers. And so they focused their attention on what they call high income earning taxpayers. And so Division 293 applies in the 2017-18 year to a taxpayer that earns $250,000 or more. Now that $250,000 test is based on your salary or your taxable income plus your super contributions. So if you have a salary of $249,000 and super contributions of $15,000, you're up for Division 293. So what happens is you lodge a tax return. The tax office gets confirmation at that point of your assessable income and your contributions are confirmed through the fund, and the tax office then issue you with an assessment notice personally. And the assessment notice, whilst it's issued personally, you don't have to pay it personally. So what it is, it's an extra 15% tax on the contributions already taxed at 15 cents. So let's say you had contributions of, call it $10,000 because it's a nice easy number to work with. The tax office will issue with an assessment notice for $1,500. Now you have two choices for the payment of that. You can either pay it personally and the matter's settled and final. Alternatively, you can have it paid by your fund out of the fund, out of your super fund account. And the notice includes a declaration where you can complete that and send it on to your fund. Okay, so that's the idea behind the fund paying it. Is it's a release of the funds to pay for it, so it diminishes your balance just as if the super fund had paid it. Why do they do this? Well, I guess the super fund doesn't know what you earn. Okay, so the final assessment point is when you lodge your return. So for those who earn $250,000 or more, it's a regrettable impact. Now, sometimes it affects more people than you may think. So for example, a taxpayer who earns $100,000 who also might sell a property with a substantial capital gain in a year could end up with a Division 293 problem. The other people it impacts could be those receiving a lump sum amount. For example, you are terminated from a job and you have a large lump sum amount. The other example might be somebody who receives a super death benefit from a relative who dies. So let's say an adult child, parent dies and they've left their super. The death benefit amount might be a taxable amount, and there might be an extra 15% tax to pay. Again, that'll flow through to your tax return. So you've got CGT amounts, lump sum amounts, things like that can trigger this 293 tax in some unwanted ways. So can you avoid it? And it's pretty hard. And often we only know of these things after somebody's actually triggered the CGT event, or you can't control somebody who's deceased who leaves you a death benefit that's going to be taxed. So we can have a chat with you, give us a call if you're concerned about it, but it's a fairly inevitable tax which is going to apply. So we're sorry if that's in your situation. So I hope that helps explain Division 293 tax. We'll speak again. Cheers.